Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two co-hosts, Chris and Marisa DiNatale. How's everyone?
Doing well.
Very nice. Very good.
It's been a while since we've had the group together, I think.
Yeah.
Someone's been away.
Yeah.
Like last week, you weren't here, Chris, right?
That's
were
right.
Somewhere.
Yep.
No, I was
And the
back.
week before that, Marisa, you were away on vacation. So I'm the only. Hey,
You're the North Star of this whole thing.
I don't think I've ever missed a podcast, have I? No, in part because people move the schedule around so I can be on the podcast. It actually isn't fair. Good point. Yeah. All right.
No comment.
No comment. Yeah. And we've got Mr. Fieldhouse, David Fieldhouse. Good to see you, David.
Hey, Mark. Thanks for having me back.
Yeah. Last time was when? I remember it was hot out. That's all I remember. It was summertime.
Definitely the summer. That's right.
Yeah.
Yep.
Yeah, good to have you back. We're going to talk about the consumer, the state of the American consumer, and obviously household leverage debt, all part of that. And that's what you focus on. So we'll bring you into the conversation to talk about that. But of course, you can participate in the entire conversation, David, if you've got a view. And we're going to play the game at some point. And you're going to play that too, right, David? You're in on that?
I got a stat.
Good. Okay. Excellente. So I guess the headline for the week, at least from the economic perspective of the economy, is the surge in long-term interest rates. This is Friday, October 20th. I think it's it's all a blur, but I think earlier today, the 10-year treasury yield got over 5% or close to. Is that right, Chris?
Yeah. And it's back down a little bit. 492 right now, but
492. Okay, so within spitting distance of 5.
Yep.
And I guess you have to go back when to find a 5% 10-year yield before the financial crisis.
Yeah.
And of course, the other related headline is the 30-year fixed rate mortgage is now going for over 8%. Right, 8%.
Yep.
I think you have to go back almost 25 years for that to find an 8% mortgage rate.
That's right.
Yeah. Okay. So lots of questions. What's behind this? Where are we headed? What are the economic implications? But let's begin with, what's going on? Why have rates risen so far so fast? And just for context, I think if you go back to when David was on the podcast last in the summer, the 10-year treasury yield was well south of 4%, probably 3.5, 3.75. So we're up a percentage point and a half, let's say, since the low back in the summer. That is a big move in a very short period of time. And the biggest increases have been most recently in the last few days, last couple of weeks. So let me turn to you, Chris. What do you think is going on here? Why this surge in long-term interest rates?
Yeah, good question. I'd say it's maybe a combination of things. There's been a lot of economic data. Certainly, there's some. I don't want to take away a statistic, but certainly there's some evidence that the economy is a lot more resilient. Consumers are a lot more resilient. Strong retail sales, for example. So you could have bond holders, bond investors pricing in that resiliency. I guess we could start with what it's not. It doesn't seem to be related to inflation expectations, right? I think you'd agree there. There's no evidence that the higher yield is
right.
Yeah, which is good. Right. So it's not that investors are requiring a higher yield because they expect inflation is going to be taking off here. So that is a good thing. And it doesn't seem to be related to the short-term rate, right? The short end of the curve, the 3-month, 6-month, that hasn't moved much at all, right? So it's not that that's having an influence on the longer end. So it's really that nebulous term premium component of the long-term rate, and that could be any number of things. So the resilience of the economy, certainly.
So the term premium, you got to explain that for folks. What is the term premium?
Well, in general, I'd say it's the compensation for holding on to a longer-term debt instrument. Right. 10 years is a long time, right? You have to compensate. Generally speaking, the investor will say, you have to compensate me for holding on to this debt for a longer period of time versus a shorter period of time. right? And that can be influenced by all sorts of things. I'd say it's a bit nebulous because we don't know exactly what's influencing. We can hypothesize what investors might be doing.
we're very good at it, by the way.
Of course,
Yes,
of course.
okay.
We'll
All right.
get right to it.
Yeah, feel
So I'm
free.
going to throw out some things.
Feel free.
I'll throw out a few things. You'll
Yeah.
tell me why I'm wrong. Then Marissa will come with the right answer.
Yeah,
right?
that's a good idea. Good plan.
So I'd say term premium today could be influenced by the resiliency of the economy. So investors assuming that the economy is going to be stronger for longer. The deficits, there's lots of talk about government deficits, right? Expanded government deficits, higher costs, right? Related to those. And then the third would be quantitative tightening, right? That as the Fed is engaged in quantitative tightening, right? Allowing the treasury securities that they have to run off their portfolio, right? That also is influencing, right? You don't have this large buyer of treasury securities out there as we did during quantitative easing, and that could also be causing the long end of the curve to pop up.
Right. So
What do you think?
putting it,
What do you think?
I think we're all reasonable. I mean, just to put a frame around what you said, and I think we've talked about this in the past, we kind of decompose the 10-year yield into three parts. Part one is the inflation expectations. And as you say, they feel anchored, no increase there. If you look at, and I'm not going to explain what these are, but just get it out there. 1 year, 5 year forwards or 5 year forwards. Those are no higher today, not appreciably higher today than they were, say, 3, 4, 5 months ago. So, and that's a really good thing, because if inflation expectations were rising, and that's the key to why long-term rates are going up, that will put pressure on the Federal Reserve to keep raising interest rates, because obviously they want to keep inflation expectations tethered, anchored, because that's key to getting actual inflation down. So that's good. Second part of this decomposition is expected real short-term interest rates, and that goes to Fed policy. And here I might disagree a little bit. I do think they have increased over the last 3 months, that investors have finally bought into the Fed's forecast for rates, which is higher for longer, meaning we're going to keep rates up for a while. We're not going to be cutting rates anytime soon, certainly not this year, probably not even in the first half of next year. And it wasn't until the last couple of Fed meetings and all the jawboning and press conferences and everything else that comes out of those meetings that I think investors finally became convinced that, and the economic data, as you point out, the economic data has been very strong. Oh yeah, okay, the Fed's not going to be cutting rates anytime soon, and that has pushed up expected real after inflation short-term interest rates. So it's not that the Fed has changed policy. It's just that the market's reading of that policy has shifted here, in part because the economic backdrop has been good. I mean, the economy, as you say, is resilient and showing strength.
But the November hike, go ahead.
I was just going to finish the decomposition. That's term premium, part 3. And there I totally agree with you. Hard to know. That's like not elsewhere classified. I don't know.
Exactly.
It's like,
exactly.
we don't know what that is, but it does feel like, all the treasury bond issuance after the end of the debt limit drama, because the treasury couldn't issue debt for a long time because of the limit. Once the limit was increased, then they issued all this debt. And that kind of focused investors' attention on the government's fiscal situation, and also the governance. You can see the chaos that's ensuing even today in the House of Representatives. How in the world are these guys going to get it together to address our long-term fiscal problems, which are pretty daunting unless the lawmakers make a change. You mentioned quantitative tightening. I think that's on the margin. The Fed going from QE, buying bonds, to QT, not selling them, but not replacing the bonds that mature or prepay on their balance sheet. The one thing I would also throw in there, maybe you said this, I missed it, is just it's a market. It's a financial market with lots of momentum players, speculators, lots of technical forces at work. And once markets move in a certain direction, they tend to take on a life of their own. These speculators take over for a while, not forever, but for a while. And you had some prominent bond investors, talking up yields, saying 5%, and here we are. So I'm guessing that that's also played a role. But that's how I would frame it. You were going to say something though.
Yeah, just on the short-term rates, my point was that market has coalesced around this idea that there will not be a rate hike in November, and even the likelihood for December, it seems to be sharply reduced. But that's more in recent days or weeks. I think you were looking at maybe a little bit longer time horizon.
Well, even on that, I don't think the market ever bought into they're going to raise rates again. I mean, remember if you go back and look at
the futures market was
the futures markets were saying some less than 50% probability, right?
Yeah, but now it's 0, right?
Yeah. But I think what was, and that's probably playing a bit of a role. But more of what's going on is these rates out into the future, out into 2024 and 25. The market, I think, if you look at forward curves, they pushed up their expectations pretty dramatically over the course of the last 2-3 months, and that's what I'm talking about. That shift up is what's behind this increase in long-term interest rates. I think that's what's going on. But I agree with you. The if I had to say of that 150 basis point, 1.5 percentage point increase in 10-year yields, let's say from 3.5 to 5, I'd say none of that's inflation expectations. I'd say probably half a point is expected real short-term rates, and probably it feels like almost a point is related to this increase in the so-called term premium, which, by the way, interestingly enough, is simply a normalization of the term premium. Meaning, before all this, it was negative, which pretty hard to explain. You can explain it, but it's really weird to have a negative term premium, meaning that investors aren't demanding compensation for buying a long-term bond. They're paying for the benefit of buying a long-term bond. The privilege of, which is really weird. It happens, but it's really weird. So all that has happened is we've gone from a negative term premium, which is really weird, to a positive term premium, which is pretty close to its long-run historical norm. So it just feels like we've kind of normalized here. Okay, Marisa, you've heard this conversation. Anything you want to add in or anything to say about that?
I think that all aligns with the way I'm thinking about it. We heard from Jerome Powell yesterday, 2 days ago, and he reiterated the higher for longer notion, right? So I do think that he seems to indicate they're done raising rates, but that they're not going to be lowering them anytime soon. And he also, in his comments, addressed the long run fiscal situation of this country and was talking about the unsustainability of the debt burden over the long term. So I do think what's going on right now in the House of Representatives has to be making investors nervous about the ability to govern, right, and to tackle these long run issues. I mean, if we can't even get a Speaker of the House, how can we and pass any bills? How can we tackle long run fiscal problems? So I do think that some of that term premium is reflecting investors' feeling of that it's a bit more risky 10 years out into the future than maybe it was 5 years ago.
Right. I mean, I think we all knew how risky it was going to be. Even if government was operating reasonably normally, it would still be pretty tough to do the things they need to do.
Yeah, they've never done it before, right? They always kick the can down the road.
Now you throw in.
Now it's impossible.
Yeah, it's like, okay.
Yeah.
Well, we have an election coming up next year. Hopefully that kind of helps out here. We'll see how that plays out. But yeah, I know that feels like wishful thinking at the current point in time. Okay, so we've seen this increase in yield. We're up to 5% on the 10-year bond, 8% fixed mortgage rates. We'll come back to what it all means for the economy. But why it doesn't feel like hair on fire? It doesn't feel like people are really that worried or panicked or nervous about it. I mean, my barometer for that is the stock market. The stock market, it's got red on the screen, but it's the S&P 500 is at 4,250, which is still within kind of the range it's been, for the past more than a year. It's basically been flat. So as interest rates have been rising here, the stock market hasn't risen, but it hasn't really fallen either. It's kind of hanging in there. You look at, credit spreads in the bond market, other kind of VIX index, other measures of perhaps investor angst, and you don't get the feeling that investors are on the verge of losing it. Now I'm sure that can change in an instant. We could see some big sell-offs here. That's very possible, but we haven't so far. Why? What's going on? Do you have a view on that, Chris?
Yeah, I think for most households and businesses they're fairly insulated from these rate hikes, right? Let's start with households, right? If you have a mortgage, 2/3 of households have mortgages or own their homes. Half of those have a mortgage, right? They've locked in this ultra low rate, 3.5%, 4%. So for them, it doesn't really matter, right? Mortgage rate goes to 8%. They're not moving. They would no plans to move when the rate was at 6. They still don't plan to move when it's at 8. But they're just paying that monthly bill, very predictable, right? So no problem for them. There is, some increased use of credit cards, so that is adjustable rate. So there you will feel some of the pain, but that again is tied more to the short term or the short end of the curve versus the long end. So there too, it's high. Don't get me wrong, but it hasn't really shifted all that much because of the rise in the 10-year. Then businesses too. A lot of corporations certainly have borrowed already in anticipation that rates were going to rise at some point. So they don't really need the capital right away. So I think that's why there's a moment of calm here. If this persists or if rates were to go higher for an extended period of time, that of course would be more negative. And then you'll start to see more red on the screen. But for the time being, I think by and large, most households, most businesses, relatively immune from the effects.
So my interpretation of what you're saying is it's not like hair on fire out there, because the economic fallout of a 5% 10-year treasury yield, an 8% fixed mortgage rate is okay. It's definitely negative, but it's not a big negative. The economy can digest that. So I'm an equity investor. I own stock. I'm not going to be buying in that environment in that situation, but I'm not going to be selling at that.
Right.
Okay. That makes sense. Marisa, what do you think? Why such a sanguine kind of perspective on all this?
I agree with Chris. I think people haven't had to face the reality of 8% rates yet. We know that the vast majority of homeowners, like 70%, have a mortgage rate under 6%. So the housing market's not going anywhere. And we saw that this week in the housing statistics, right? People just aren't going to move. They're going to stay in place. Sure, adjustable rate debt and, auto loans, right, which are a bit longer and are facing higher rates, but that's a small part of the overall economy. They still have a lot of saving. And I think we'll talk about this too when we turn to the consumer. They still have a lot of savings. So they're not having to dip into these revolving debt instruments to the extent that they're really going to feel these higher rates yet. So yeah, I just think that they haven't had to face it yet. Now, I would say there is a lot of corporate debt that will come due in the next couple of years. So there will be businesses that are going to be faced with having their loans come due in a high rate environment, and they're not going to want to refinance it, the rates that are out there now. So that's something maybe we can talk about or consider, of how big of a chunk of the economy is that, and does that pose a risk economy wide? But in terms of the consumer and households, they're just insulated for the time being. I mean, if this continues for a couple of years and excess saving is completely drawn down by a lot of households that need cash for spending, then we might be looking at something different. We might be looking at a riskier situation, but I think right now they don't need loans at 8%.
Maybe the other reason, and I agree with all that, although I want to come back to the corporate debt. I'm really curious what data you're looking at. In fact, maybe we can bring that up, and I just got a stat for the stats game. I hope I didn't give it away, but
corporate debt.
Actually, it's more the commercial real estate debt. It's
CRE debt.
Yeah, right. So I think the corporate debt is not that large, but the CRE debt coming due over the next couple of years is big.
Yeah. Okay. Maybe the other reason why no hair on fire kind of reaction is people think rates are going to go back down.
Mhm.
That, the odds that we go from 5 to 6 is a lot lower than the odds we go from 5 back to 4, right? That would be that's my view. I mean, if you kind of step back and say, okay, fundamentally, what's at the top of the list of the reasons why yields are higher, what we're basically saying is it's kind of a stronger economy. The economy's been strong. I mean, our real GDP tracking estimate for the third quarter, just in the third quarter, and we're going to get GDP next week, is around 4%. That's really pretty strong growth. That's not some one-off thing. That's strength across the board. Consumer spending, business investment, government spending, the whole shooting match. And that's double the rate of the economy's potential. But we do, at least I think we know, that it's going to slow pretty dramatically in the fourth quarter and first quarter, right? Because of all the headwinds we've been talking about, student loan payments, UAW strike, government shutdown, the higher oil prices, now the higher long-term interest rates. So if growth slows, that feels like it's going to take the steam out of things, wring out those speculators and momentum players that we were talking about, maybe cause bond investors to become a little less nervous about what the Fed's going to do on short-term interest rates, and we get interest rates coming back in as opposed to going higher. And so you've got that view that, well, this isn't great, we're at 5, but that it's we're not going to 6, we're more likely headed back to 4, then no problem. Does that resonate? Chris,
Yeah, and that is our forecast, right? By the end of next year, we see the Fed lowering rates, starting to think about lowering rates. So even if rates stay high for 2024, I think most people think, well, I can tough it out for another year. They'll be headed back down by 2025.
Yeah. What do you think, Chris? Does that ring true to you, that argument?
It does. I'm wondering, are you adjusting your bond portfolio? Should I call my broker? Or?
I haven't. I've been thinking about it though. I've been in short-term bonds, a lot of municipals for obvious reasons. And I buy the bond. I don't buy a bond fund. That always makes me nervous. But I've been in short-term bonds, and I wonder, feels like, geez, this feels 5%.
What are the obvious? You said for obvious reasons. What? It's not. Why are you in
I pay a lot of taxes. I pay a lot of taxes. Sorry. Exactly. But I've been thinking about that. But okay. And in terms of, it sounds like the third question I asked was, what's the ramifications of this for the economy? It sounds like what we're saying is the reason why no one's hair's on fire is because it's a headwind, but it's not going to blow the economy over, at least not by itself. Is that right?
Not yet, right?
Not yet.
Yeah, this is
here,
new news, right?
Exactly.
As this persists, things will change, but
right,
the rates could be back down next week, right?
Right. I am thinking that our forecast, you mentioned our forecast, Marissa, may be a bit too optimistic, meaning we've got
push it out further.
Yeah, we've got yields coming back to 4 and even a little bit below, and kind of that's where we expect them to remain. That's kind of for a long time we've been thinking that 4% is kind of the long run equilibrium 10-year treasury yield. That's consistent with nominal potential GDP growth, and in the long run those two things should be roughly equal. I won't go into reasons why we talked about in the past, but that's kind of the stake in the ground that we use. But I'm wondering if not, the stake in the ground should be at 4.5, 4.25, because the economy is so resistant to these higher rates for, the reasons you described. That are kind of features of the economy that have developed over the course of the last 5-10 years. The fact that rates are so low and households and businesses locked in those low rates, that's kind of sort of unique to the period, right? And it does make the economy more resistant. We can talk about other ways that the economy is more resistant to interest rates, but that's one of the obvious ones. Therefore, to get the economy to a growth rate that's more consistent with its potential, maybe for a while, we need to see higher yields than we thought, not 4%, but maybe, as I said, 4.5%. That also goes to the kind of the long run equilibrium federal funds rate target, the rate the Fed controls, the so-called R star, similar kind of arguments. Maybe that should be a little bit higher, up to now it was 2.5. Maybe it should be closer to 3, something like that. What do you think, Marisa? Am I making sense?
Yeah. Yeah, I think that all makes sense. I mean, the interest rate sensitivity of the economy really hinges on housing, financial markets, right? Loans that households and businesses take out. And as you said, we're very much insulated from much of that. So I think psychologically, households probably aren't even processing that interest rates are so much higher because they're just not really having to face it unless you're looking at putting your home on the market or buying a house right now and you realize mortgage rates are 8%. But we were in a period of, I mean, pretty much my whole life that I can remember, we've been in a period of very, very low interest rates. So I just think people there's a lot of people out there that they haven't processed this kind of new world order with interest rates yet. And you're right. I think it's going to take a while for this to manifest itself in the economy. I wonder, if I wonder about your opinion about, you mentioned corporates had locked in low interest rates as well. What about other segments of the economy where loans will come due?
What are you thinking about? I mean, there's the household sector they've locked in, the corporate sector,
commercial real estate.
Yeah, see, you mentioned CRE. We've done a fair amount of work. It's not inconsequential, but it's very manageable. I mean, if you look at the CRE mortgage debt that's coming due through 2025, by our calculation, it's 1.5 trillion. Now that sounds like a lot, but in the grand scheme of things, not so much. And in the office market, the CRE mortgage loans for office properties, that's 300-400 billion. In the banking system, 100 billion over that period. So not inconsequential, but it doesn't feel like the tsunami of debt's going to come pouring in. And the other thing is, we're seeing a lot of forbearance, I think, being shown banks are showing a lot of forbearance on when loans are rolling over and need to be refinanced. They really don't want to push a owner over the cliff and into default, because they know that it's going to lead to distressed sales, more price declines, and make everything even more difficult. And even the regulators, I think, issue guidance. When I say regulators, I mean the Fed and the OCC, and they have to say, "Hey, guys," and it didn't say it this explicitly, but this is what they meant. Be judicious in how you do these things. It doesn't make a whole lot of sense to push a lot of people, into default. So
yeah.
But nonetheless, there is debt coming, and to both of your points, the longer rates remain high, and stay there, the more difficult all this becomes, and this debt rolls over. Here, I wanted to mention one other thing, though, that goes to the point that the economy is more resistant to rates, and that is the most rate-sensitive sectors of the economy are single-family housing and the vehicle industry. This goes to consumers, and for very idiosyncratic reasons to this period, those two sectors are less vulnerable to the higher rates. In the single family housing market, it's because there's a shortage of homes. There's we got a lack of affordable homes. I mean, vacancy rates, the homeowner vacancy rates at a record low. And so that cushions the blow, from the higher rates. Certainly on home building. I mean, not home sales, but home building. In-house prices. And in the vehicle sector, you've probably got some pent-up demand, right? Because during the pandemic, global producers couldn't produce, so prices went skyward, people couldn't buy, and there's a kind of a underlying latent demand for new vehicles that is putting a floor under vehicle sales and making it unlikely that we're going to see big declines in vehicle sales, even in the context of higher interest rates. So those two rate sensitive sectors of the economy are much less sensitive today, again, because of the features of the current economy. Does that resonate with you, Chris, what I just said? Did that make sense?
It does.
Okay.
It's a bit of a mixed bag, though, right? yeah, there's some resilience there, but that doesn't necessarily help our inflation project, right? Or the
Yeah, but that's because you're wrong about inflation. You keep going back to demand. It's not about demand. It's all about supply, and inflation's coming in.
Do you think the supply is going to ramp up in housing anytime soon?
Yeah, the multifamily side, yeah, it's coming in. We're going to
the completions. I guess
completions, yeah.
Okay.
In terms of rents, which is what matters in terms of measured inflation, right? So, yeah, I actually think so. And I on the vehicles, I do expect. On the other side of the UAW strike, obviously, but I do expect we'll see a lot more supply there, and that should bring new vehicle prices down at some point over the next 12, 18 months. So yeah, absolutely. I'm counting on supply. Yeah, for sure. Yeah. Hey, anything else on the long-term interest rates while we're on the topic before we move forward? Anything I missed? Anything you want to say? Just going.
What's the yield curve looking like?
Oh, that's an interesting question.
I mean, because
that's an interesting question. Oh, that's
Yeah,
really interesting.
because it could be soon not inverted.
I know.
Well, let's not go crazy now.
Well, okay, so the 10 years at 5. The federal funds rate target is somewhere between 4.25 and 4.5. Probably let's say 4.35. Excuse me, 5.25, 5.5.
Okay.
So it's let's say 5.35. So it's 35 percentage point difference inverted. 10-year yields are the Fed funds rate is above the 10-year yield. That's within spitting distance, though.
Yeah, it is. And if you do, the 2-year is at 509.
It's 509. I didn't look.
Yeah.
Is it 509?
Oh, that's really spitting distance.
That's within spitting distance. Yeah. I don't know. If you go
does it
back
matter? Does it even matter though?
Well, it is interesting. Go ahead, Chris. Go ahead. Say what you want to say.
If you go back to your economic history, right?
Oh boy.
It's not the inversion that leads the recession. It's the reinflation or the steepening of the curve after that inversion that then is correlated with the recession after it. So
it's the next step. So the curve inverts, then it becomes positively sloped, and then boom, you're in recession.
And then you're in recession. So I don't know if we want this.
But here's the thing about that, Chris, because that dawned on me. So I went and looked. Let me ask you, historically, why does the curve reestablish a positive slope right before recession? What's causing that? Is it the short-term rate or the long-term?
Right?
The Fed's cutting.
Right.
The Fed's, and it's not about the 10-year yield rising. It's about the Fed.
So it's the short end of the curve.
The Fed says, "Oh my gosh, I screwed up. I pressed on the brakes too hard. We're going in." They then take their foot off the brakes, slam on the accelerator, and the funds rate declines. Short-term interest rates decline. So you're already going down the slippery slope into recession and the Fed knows it and everybody knows it.
Yeah.
This time is
different.
Oh God. You said it, not me.
Oh God.
You both said it.
Yeah.
You're finishing
right?
each other's
I'm not kidding,
sentences.
Right? So it's all about the 10
Well, that
years,
is what is happening right now.
Yeah.
Yes, for sure. 100% for sure.
100%
what is happening right now.
This is totally different. If the curve goes positive again, for totally different reasons. Yeah. So anyway, let's play the game, the stats game. The game is we all put forward a statistic. The rest of the group tries to figure that out through cues and clues, deductive reasoning. The best stat is one that isn't so easy we get it immediately, one that's not so hard that we never get it, and one that's apropos to the topic at hand. We've been talking about interest rates, but we are going to talk about the consumer, and of course you can talk about anything you want. You can have a stat about anything you want. So tradition has it, Chris, I nearly blew this last week.
Oh, did he?
Yeah, I did. I nearly blew it. Marisa, you're up.
Okay. I think you'll get this. So I think you're going to get it, Mark.
Oh, just Mark.
Just Mark.
Oh, wow. That stings.
You'll probably all get it, but Mark is definitely going to get it. Okay.
Now I'm not going to get it.
But I like it. I want to talk about it. So that's why I'm using it. Okay. So don't berate me for using a statistic that's
I'm going to still berate
too simple.
You. Go ahead. Yeah.
Excuse me. $192,900.
$192,900.
$192,900.
$192,900.
Correct.
Oh.
Oh, really?
Oh yeah, come on.
Oh, really? It's really that simple. David, do you have any idea?
No, I don't.
Federal Reserve, Marissa?
Yeah.
Source? Yeah. A survey that came out recently?
Survey of Consumer Finance?
Clearly, you know what it is, Chris.
Is it
Say it
net
before
worth?
Mark
Is it like
does.
is it median net worth or something?
That's right. It's median net
Oh,
worth
yes.
in
Oh, okay.
2022 of U.S. households. Yeah,
Okay, there
I
you
was
go.
going to say 37%, but I knew you would know that. Okay, so
yeah.
the survey of consumer finance came out a few days ago, and it's the first one of these surveys that the survey happens every 3 years. It's the first look we have at kind of pre and post pandemic view of household finances. And it's chock full of really cool data. So we get data on income, net worth, assets, debt, all kinds of things. They ask questions about COVID and work experiences during the pandemic. So the median net worth of all households rose 37% between 2019 and 2022. And that is an all-time record as far as this survey goes back. And if you look at the previous record, this is more than double that. So the previous record had been an 18% rise in median net worth. That was right before the great financial crisis. Median net worth for households rose 37%. Mean net worth rose 23%. So there's actually some compression between the bottom end of the income spectrum and the top end of the income spectrum in terms of net worth. That wasn't the case with incomes. So when you adjust for inflation, incomes rose 3%, and it was like 20-something% before inflation. There was greater income inequality, but in terms of net worth, there was actually a little bit of compression between the top and the bottom. So 192,900 is the actual dollar amount of median net worth that households have. And it accrued to pretty much every demographic group. So that's true up and down the income scale. It was true of all ages, all races, all ethnicities, education, generation. So it truly showed us what we already knew, right? Because we've had estimates of excess saving during the pandemic. We obviously know how very strong the consumer is, how strong the job market has been. But this really shows us that households were able to really sock away a lot of money up and down the income spectrum during the pandemic because of the stimulus that a lot of households got directly. We had the forbearance on all kinds of debt going on. We had expanded unemployment insurance benefits, expanded other sorts of federal benefits like food stamps. So we had PPP loans, right? So there was all this stimulus in the economy at the same time that we couldn't really spend money on services. So people really were able to save, and net worth, if you look at the components of it too, you see more people were able to start or contribute to retirement accounts. More people own stock than they did before. These things are modest, but you see it kind of across all of the different income categories. And at the same time, we saw debt not really change very much. So people did not take on more debt during the pandemic, generally speaking. I mean, of course, there are different outcomes, right? There's a lot of people that lost jobs during the pandemic, and they obviously didn't fare as well. But debt was pretty tame in terms of the change over that period. And just debt service actually fell to a 30-year low over that period of time, too.
Yeah, do you know the Survey of Consumer Finance, the triennial and every 3 years? When in the year is it conducted? So when they say 2022, when in 2022?
Yeah, so actually it does capture, it goes through April of 2022. That was the last month where they were conducting the survey.
Okay,
So it
sense.
does reflect sort of the start of the right after Russia's invasion of Ukraine, and the Fed had started to raise interest rates in March. So we do get a little bit of that. And of course, inflation had been high prior to that, right? Just with the reopening of the economy in 2021 and supply chains being gummed up. So we were already in a higher inflationary environment. And then the Russian invasion of Ukraine put even more pressure on that. So there was some of that captured in this survey.
Although if
they do it over the course of several months, though.
But if they do it now, if they did it now, it wouldn't look nearly as wow, right? Because
Sure, right.
yeah, because stock prices are down, housing values are down. Um, so I would think it's still up a lot from where it was pre-pandemic, no doubt. People are still a lot wealthier, but not nearly as wealthy as those data seem to suggest.
Yeah, I mean, we had a
guess.
40% increase in house prices over a 2-year period, and this reflects that.
Yeah,
Housing
forward.
inflation and the stock market had done really well, right?
Yep.
Then it kind of tanked throughout 2022.
Yeah,
Home values went nowhere or fell slightly. So yeah, it does not capture the decline in asset values that we saw through much of 2022.
yeah, but it's a good statistic, particularly in the context of the consumer, which we'll
Yeah.
get to just after this. Hey, David, you want to go next?
Yeah, I'd love to. So my number, it's 20.5. This is a number that it didn't come out this week.
Oh.
It was released earlier this month. That may be a bit of a hint, but 20.5.
20.5. And is it a percent?
It is a percent. Yep.
Hmm.
20.5%. Yep.
And it has
Credit
to do
credit
with
related.
Consumer credit related?
Mm-hmm.
Is it a growth rate?
Nope.
No.
And is it a government statistic?
It is not a government statistic.
Oh, it's okay.
Is it from the Equifax data?
It is.
Okay.
Is it you said it was not a growth rate.
It's a share.
Yeah, a share of something. Yes.
Share of something. Okay.
So the share of households that have a consumer finance loan.
It's I would say it's more of a share of a different type of statistic.
Is it
so
Of a different type of statistic.
Oh.
yeah, so it's a one portion of another statistic. I don't know if that makes any sense, but
yeah, okay, so it's not something like the
two numbers. It's a division that's going on here.
Yeah, right. Yeah.
it's not a delinquency rate, is
Nope.
it?
No.
It's too high. It's some sort of debt service.
Getting closer.
I don't know.
No, but
It's David comes up with these weird statistics.
yeah. Let's see. It's a statistic on something that you all have, I presume.
An auto loan.
No. No.
There's even more of them out there. You might have a couple of them, maybe.
Credit cards.
Power washers.
Yeah. Credit cards.
Mark's wealth is in power washing machines.
Or power washers.
Yeah. Thank God I didn't finance them. Jeez.
Yeah.
So something related to credit cards.
Credit cards.
Oh, no. It sounds like a credit card interest rate almost.
Is it the percent of households that have more than 3 credit cards?
No. It's a measure of how much households are stressed, but it doesn't have anything to do with delinquency. It's has something to do with credit cards.
Is it like the share of the balance they're carrying over from month to month?
Yeah, the utilization rate.
Okay. So the utilization rate is 20%.
20.5%, exactly.
20.5%.
And the reason I bring that one up is that it's getting very close to where it was prior to the pandemic. So if you look, there's obviously seasonality in credit cards, but that's when you look prior to the pandemic, September. So this is a number from September. It's September 2029. It's 20.7%, and right now it's 20.5%. So what that says, right? The utilization rate it's almost where it was prior to the pandemic. We haven't got there yet, so it's going to seem a little bit boring, but it was increasing pretty rapidly. We've seen growth in the credit card space, credit card balances. That's been pretty aggressive. It's been slowing. It's been still coming in, but we're still seeing some growth, and we still have some room to grow on the credit card side. So this does suggest that households are still have some wherewithal. And can still continue to borrow, but their borrowing is increasing. And when we think about that, that conversation we had about the interest rates, right? Any balances that they're paying interest on is going to be quite expensive, right? So that's going to start to be something to continue to watch. But right now, it's still manageable. We're almost back to where we were prior to the pandemic.
Sorry,
And
I'm sorry. Go ahead.
I was just
Chris.
going to say, maybe you should define the utilization rate for listeners who may not know.
Oh yeah, no, that's great. So this is basically the balance relative to the total credit lines outstanding. So total balances divided by total credit lines outstanding for the population in the United States. So it's essentially the fraction of the credit card line that's being used. The higher the utilization, the more stress that these borrowers are, the more likely they're going to turn to revolvers, pay more interest.
And I got cut off because of my Zoom problems, but you said the utilization rate on cards is 20.5. What is it typically?
So just prior to the pandemic in the same
Yeah.
month, it was 20.7. So it's been
Almost
rising.
there.
We're almost back to where we were prior to the pandemic, but we're still not at the level where we were prior to the pandemic. So we understand mortgage financing is in pretty good shape. But when you look at credit cards, by this measure, if you look at utilization, we're still okay. But it's definitely been the fastest growing consumer credit segment out there.
Oh, okay. So we're just back to pre-pandemic. We're not above pre-pandemic.
No, and I think the question, no, we're not back to where we were.
Okay.
I mean, there was a lot of headlines out there about the.
Well, there's no difference between 20.5 and 20.7, is there? No, you're not saying that. No.
No, I mean we're essentially where we were.
The difference is
Yeah.
0.2.
Right. Yeah. Right. Thank you. Thank you
According to my calculations.
for that calculation.
David.
Yeah. Okay. Very good. That was a good one.
I had a quick question on that one. Do you know if that's is that more people who typically revolving or just revolving more? They're taking on more debt, or do you see more people who are typically transactors? Right, they usually pay their balance off every month, but now they're starting to revolve more. I think the dynamic could be different.
Yeah, it's a great question. I think we are seeing fewer revolvers prior to the pandemic. So when you look at things like the utilization rate by different credit bands, you're actually seeing that the utilization rate is pretty much lower in every single band except for the highest credit band. So what I'm saying is that subprime borrowers are using their cards less than they did prior to the pandemic, the typical subprime borrower, but the very highest segment, the super prime borrowers, are actually using the cards more. So when you think about some stories out there about retail spending overall, and a lot of additional spending by wealthier, more established people, that's very consistent with that super prime population, just using it for more transactional purposes and not necessarily revolving. So that's the only sliver we're actually seeing high utilization rate is really the people who are unlikely to really need the credit cards for revolving purposes.
I see. So could that be just inflation related? Right? People are swiping for gas. Gas costs more. But doesn't really point to stress. But
no, yeah, and I think it's I don't think it's pointing to stress at all. I think it's just they are swiping more. You're right. It could just be gas prices. It also could just be that this wealthier, the wealthier part of the population potentially is just spending more overall.
Okay.
Yeah, that was a good one. Very good. Thank you. Chris, you want to go next?
Sure. 4.5% and 13.8%. The same statistic, just for two different
Government
groups.
statistic?
Government statistic.
Retail sales?
Nope.
Came out this week?
Came out this week.
Consumer related?
Yes.
Okay. Marisa, you're pretty good at these.
4.5
and
13 is one like month over month and one year over year.
Well, they're both year over year.
They're both year over year.
Yeah. What else came out this week?
There was housing data.
Yeah, there was housing. There was
There
existing
was-
home
Housing.
sales. Anything on existing home sales?
It's not. It's not housing
It's
related.
not housing.
Not housing, consumer related. Yeah. Huh.
The beige book.
Can
The
you give us a hint?
It is income related.
Income related.
Oh, is it average weekly earnings?
You got it. You got
Oh.
it. 4.5 is the total, right? So full-time workers' weekly earnings went up 4.5% over the last year. Any guesses on the 13.8?
Same report?
Leisure
What's that?
hospitality.
No, same report, just a different demographic.
Yeah. Who's up 13.5? Wow.
13.8, but
13.8.
It's a demographic group. It's not an
yes,
industry or something.
correct.
Um,
The young or the old?
Young.
the young.
Yeah, it's got to be the young, right?
No, it's the old.
Really?
65
Wow.
plus, wages up 13.8%.
What's that all about?
And it's a complete reversal, right? You're right.
Yeah.
Yeah.
More recently, it was the young getting the big increase.
Yeah.
I don't know. There's no detail, but
No, interesting.
you know, they also had a 7.6% increase last quarter, so it's not just one.
Job switching.
Possibly. And
By the older demographic.
Yeah.
Went back
How
in
old?
and-
65 plus.
yeah,
That's weird.
it could be
Yeah.
a mix issue potentially, right?
Yeah.
Yeah.
It could be just data. Usually
yeah,
when you can't
but
explain it, it's
data.
a data problem.
Or we like to think there's a data
It's
problem.
got to be a data problem for sure. Yeah.
It doesn't fit the narrative.
Doesn't fit the narrative. Yeah. Yeah. Interesting.
But the 4.5 is the metric to focus on, right? Because that is coming in. It was 5.7% growth last quarter, right? So that wage growth is slowing.
Okay, good. Right.
Yeah.
Right. Yeah. Okay, good. Let's move forward and talk a little bit about the consumer. And let me preface this by saying I sent an email to you guys earlier in the week and said, what do you think we should be talking about this week? Chris, you came back and said the consumer, and because intimating that the consumer is fragile in some way, and that might be some kind of threat to the economy. And I immediately thought the opposite. The consumer's in really good shape and doing their part and hanging tough. And one of our other colleagues, Scott Hoyt, who we tried to get on because he follows the consumer carefully, couldn't because he's away, sort of said the same thing. Goes, you know, what are you worried about? What's concerning you? So what's concerning you? What's going on? I mean, why are you worried about the consumer?
Well, we're future focused, right? So
Okay.
worried that the consumer is facing headwinds, right? The student loan debt is one of the headwinds you mentioned earlier. David, I think, alluded to debt growing, right? So particularly credit card debt, which is adjustable rate, right? So certainly there are some threats here, and we are projecting a slowdown in the economy overall. So some of these tailwinds in terms of labor market and wage growth, right? They're not going to be blowing quite as hard. So I think we need to continue to focus on the consumer because the consumer is really the in charge here of our economic futures, right? So that's that was the motivation.
I see.
No,
So
I agree with you. Current data or most recent data, no problem, right? Things are looking even better than expected,
right?
But higher rates, going into an environment, potential slowing,
right?
What do we expect?
I mean, it would require. You're right, because right now the consumer is hanging tough, doing their part. To describe it how you want to, but the numbers look pretty good, right? I mean, overall, real after inflation consumer spending is 2% ish, give or take, depending on the month. That's exactly where you'd want it to be. That's strong enough to keep the economy moving forward, and not too strong to fan inflation to any significant degree. And all the fundamentals look pretty good to me. I mean, jobs, low unemployment, wage growth is moderating, but it's now growing more quickly than inflation, particularly for low wage workers. Leverage is low, debt service is low. People have locked in, as we discussed. Net worth is up. Asset prices are up. They're not as high as the survey of Consumer Finance says because it was done early in 2022, but it's still, people are in pretty good shape. A lot of excess saving. A lot of debate as to how much, but no matter how you debate it, there's still plenty there for middle and high income households. So you kind of scan the income and balance sheet of households. You say, I mean, there's always things to worry about, but broadly speaking, it feels like it's on pretty solid ground. No?
Yeah,
Chris, no? Yeah.
Currently, certain there are pockets of risk, though, right? Delinquency rates are rising, right?
Well, let's take one at a time.
Okay.
I'm going to play economist psychiatrist. You're always so worried. Let's just let's unpack your fears, Chris, and let's take them one at a time. Okay. You mentioned delinquency. Is that where you want to start? Is that your darkest fear for the consumer?
It's one of them.
Okay. All right. Let's start there because we got
Let's start.
David. We've got the specialist in the house.
Yep.
So, okay, what's your fear? Articulate your fear on delinquency. I guess it's on debt, consumer debt and leverage.
Right. Yeah. In terms of
Not you,
delinquency,
David.
Oh.
First,
No.
Chris. Chris is on the couch.
Chris is the one that's scared.
Chris is the one who's scared. We're going to listen to his fears, and then I'm going to ask you, make him more scared or make him less scared. You're going to play. We're going to play. You're going to play specialist. But go ahead, Chris. What's articulate your fear?
Sure. So revolving debt is increasing, right? Borrowers are continuing to add to their credit card balances, particularly for lower middle income households, right? So that is going up. I don't think there's any debate around that. Interest rates are high and no sign that they'll be falling anytime soon. So those monthly payments will continue to rise. The delinquency rates are rising today. They're at levels that are, and let's focus on credit card. That's probably where my biggest credit card consumer loans, probably my biggest fears. Those delinquency rates are rising. They are either at or above 2019 levels. And that's occurring at a time when the unemployment rate is still relatively low and we project it to go higher. So those delinquency rates are bound to rise further. The fear is that given this environment, you'll see more consumers having to cut back, having to pull back, right? That certainly could lead to higher losses, higher defaults in terms of banks, tighter lending standards, and then just a more general slowdown in spending growth.
Okay, so David, is Chris on solid ground here? Has he got good reasons to be nervous about what's going on?
I think there's definitely some reasons to be concerned. I'm going to try to be a little more optimistic. Sometimes I come on here and I'm a little pessimistic here, so I'll try to take a
just be real.
counterpoint.
Just be real.
Just be real.
Yeah. I want to know your real feelings.
I'm definitely concerned about the pockets where so you see the finance loans that are out there. There's definitely been some bad loans that have been issued since the pandemic. They're seeing very high default rates. If you look at subprime auto, especially in the used car market, very, very high default rates, very, very high delinquency rates. But that is a very isolated set of loans and consumers. I think you've seen on personal loans, especially finance personal loans, high delinquency rates, high default rates there, higher than prior to the pandemic. So those are areas of concern. However, there's been tightening overall. So you have seen tightening in the finance lending overall. So we're not having loans just issued to anybody who maybe doesn't have the capacity to repay them. Lenders have been tightening for the last year, and we've really seen that come in. So I think that's a reason to be optimistic. And so some of those higher delinquency rates are just coming from those bad loans. And if we don't have the poor issuance anymore, tighter lending standards, we should see some of those delinquency rates potentially come in a bit. Now, Chris's point, though, is very valid that there are some high delinquency rates overall, and the economy is in really great shape. So what happens if the economy deteriorates? That would be my biggest concern is where does the economy head? And then the other, the other concern I have is really, is the current debt levels sustainable for a wide portion of the population, given where interest rates are? So, if you look at the credit cards that are being assessed interest right now, you're seeing interest rates around 23% for credit cards. Prior to the pandemic, that was closer to 16, 17%. So, I mean, that's a meaningful difference. If you start revolving on those cards, very quickly things can get out of hand for some borrowers. So we don't have a ton of revolvers right now out there based on historical standards, but there are some. And I think that could be quite problematic.
Feel any better, Chris? Or I don't know. He said he was going to be more optimistic. I'm not sure.
I don't know.
Yeah, I mean,
you brought up 3 other reasons to worry. I don't know.
Yeah, no. But I always talk myself in there. But I will say here's some reasons to be optimistic. Mortgage financing is in great shape. So we've talked about that. When you look at things like the Pulse survey, how households are facing potential hardship, that's actually improving. So more households today are indicating that they're going to have be able to make their payments than they did a year ago, and it's been sort of improving over the last couple months. So
just for the audience, the pulse surveys, this special survey census has been conducting since the pandemic on an irregular basis, and it's very detailed in terms of the questioning, and you get some really good granular information about things like how hard it is for them to pay on folks to pay on their debt by income, by age, by different demographic groups. And you're saying that feels like it has a better tone to it. That's what you're saying.
Yeah, it's more households are indicating they can make payments today than they were several months ago, a year ago. So there's been some improvement in the trajectory there. So
Which I
some
guess
of that
makes sense with inflation coming back in.
And the job market's strong.
That's remained strong. Yeah.
Yeah.
Okay. Here's the thing, Chris, that I take solace in. How much car debt? Here's a good statistic. How much David, I know you know this. I'm sure Chris knows it as well. But how much credit card debt's total outstanding?
Was it 900 billion, $1 trillion?
Trillion now.
Trillion. It's about $1 trillion. And of course, that includes everybody, right? Folks like me who are, I don't borrow against the card, but I use the cards a lot, and that's reflected in the data. So $1 trillion. How much consumer finance is there? That's buy now, pay later. All the consumer finance stuff. How big is that? Do you think, David? You probably
200 billion, probably.
And how much?
Yeah. 200. There's different estimates. 250.
Yeah, give me
billion.
the highest one you got. Give me the highest
I think
one
it's around 250 billion.
Yeah, 250 billion. Okay, take subprime auto. How big is that? The whole shooting match. What do you think? 400 or 500 billion?
Yeah,
maybe. Yeah, if that.
Okay,
even.
you add that all up. I mean,
2 trillion.
Really? Well, that and on the cards, I'd say no more than half of that's real debt.
Okay.
So maybe it's $1 trillion in debt that you're worried about, but in the grand scheme of things, there's what are total household liabilities? 16, 17 trillion, something like that. So I don't know. It's hard to get worked up about. I mean, I'm not arguing it's not an issue, a constraint on particularly low income consumer spending, but it's hard to get to a place where it could be existential in some way to consumers, the thing that really dings consumer spending in a meaningful way. No? Or
I agree with that, but what about some of these households that might be stressed now having to pay back student loans as well?
Yeah. Oh, talk about that, David. I mean, you're pretty sanguine about that too, right?
Yeah. So the great thing with the resumption of student loans payments is that there is a on-ramp period for all of this, right? So it's going to take basically a year until next October before we report it to the Bureau. The government's letting everybody sort out new servicers and everybody getting used to paying again. So I think what's going to happen here is that you will start to see payments resume. We are seeing student loan balances being paid off at a record rate by obviously the people who are ready for this, and for those who aren't, they're going to have a year to adjust. I think you'll see people making payments. The only real negative of not making payments right now is that you're going to be assessed interest rates or interest. So you'll want to start to pay back that debt to avoid accruing additional interest, and you'll see people start to pay that back. They're going to start to work through their precautionary savings. So that's maybe a concern that's out there. So you're able to pay your student loan and your credit card today, but you're going to start to draw down on your excess savings. Eventually, you get into trouble. Let's say it's next year. Now you don't have the same level of savings. Now you have trouble making the payment to that credit card because you already started paying this student loan. So I think there's a bit of concern out there, and we do see a correlation between student loans and unsecured debt overall. So those are the categories where people may have trouble making payments, but overall, because of this on-ramp period, it's going to be a very soft easing back into the world of paying student loans again.
Okay. And those loans typically have low interest rates on the loans, right?
Yeah, yes, but they are rising. The student loan debt interest rates are rising. So the direct federal student loans are pretty reasonable. Definitely nothing like a credit card or a subprime auto loan, but they are rising. So it's another fallout from this interest rate environment that we're in.
They're tied to the 10-year, aren't they? The
Yes, yeah,
federal
yeah.
backed loans, right? So
Yeah.
could be for new borrowers, it could be
an
significant,
issue.
right?
Yeah, it could be an issue. Yeah. All right, Chris, what else is bothering you about the consumer? Leverage. I mean, I don't mean to dismiss it either. I agree with you. That's definitely a soft spot in a high rising rate environment. It's going to hurt. There's no doubt about it. You throw in the student loan payments, it's definitely going to take some steam, some starch out of particularly low middle income households in their spending. So I don't mean to diss it or dismiss it, but what else is bothering you?
Yeah,
About the
it's on the
consumer.
margin, right? We're talking about
Yeah,
the
for
margin
sure.
matters, right?
Yeah,
So-
absolutely.
What else? But well, certainly
Yeah.
the labor market has to be front and center.
Yeah,
And we have a labor market projection, certainly, that is calling for some slowing. It's not going off the cliff, but there's risk there, right? That
right.
you get an unemployment rate north of 4.25%. You know, it's
Right.
not on its own. It's not a recession necessarily, but it is starting to do some damage in terms of spending power.
Right. Yeah, that's a difficult one because it's very simultaneous, right? We're saying the
Yeah.
consumer's going to hang tough, therefore the economy's okay. But if the economy's not okay, then the consumer is going to suffer. It's like, what's the
Agreed.
causality here? It's pretty difficult to get your mind around it. But what you're saying is if something kind of pushes the labor market more off the rails, we expect it to slow under
Right.
the weight of all these things we've been talking about, interest rates, so forth and so on. If it slows more than we anticipate, then it could do more damage to consumers, and then it becomes all self-reinforcing downward. That's what you're intimating.
Correct.
Yeah.
Yeah.
Okay. But something else has to come, or I mean, at least in our thinking, if we've got it roughly right, something else has got to happen for that to occur, unless we got it wrong, unless the slowdown is going to be much more substantive than we're anticipating in terms of job creation, I guess.
Yeah, there has to be another trigger.
It has to be
right?
something else.
Yeah,
Right.
it's not on its own, right?
Yeah.
The conditions look strong, demand for labor is strong, right there.
Yeah.
There isn't any reason to believe that labor market's going to go south, but it could be the higher for longer interest rates are going to actually do more damage than what we've anticipated here, right? So just as one example, or oil price shocks, that's probably another key consumer factor that that worries me, is that you could get another surge in gas prices here.
But thinking about it from the prism of the consumer income statement and balance sheet, I mean, the only kind of soft spot that you can identify is leverage among low income households, debt service, those with cards, subprime auto, student loan, maybe, but there's not something else in the income statement or balance sheet that's got you worried. It's something else out there that has to happen to cause consumers to pull back, and then you get into a kind of a self-reinforcing cycle down. But there's nothing else. I'm asking. There's nothing else. Yeah. Okay.
Again, on its own, I don't see that we could have a
right.
Or I think it's unlikely that we would have a truly consumer-driven recession where consumers, for no other reason, except for the debt that they've incurred, slow down their spending and push us into recession. I agree. There has to be some other factor that has to be layered on top.
Yeah, because in times past, if you look at other periods prior to recession, the consumer, there were more issues, it seems to me. There was more what I'd call spent up demand. People had bought forward, in the vehicle industry, that was common, that the vehicle producers would provide these big discounts, zero rate financing, pull forward sales. So when things started to soften up, people really pulled back because they had bought ahead of time. Or, asset prices fell sharply. The stock market cratered, down 20-25% and stayed down, and knocked the wind out of high-end consumers. Or the financial crisis, too much borrowing, too much leverage, a lot of foreclosures, collapse in housing values. None of that is evident today. I mean, again, there's some blemishes around the in terms of cards and subprime auto, but it feels like that's small potatoes in the context of those previous historical experiences.
Yeah, although this could be
Okay.
more of a garden variety or in a recession, right? Not all recessions, of course, have involved
The consumer.
consumers as
Yeah.
as the main cause, right?
Yeah. In fact, it's interesting when I talk to other kind of economists who have recession forecasts, they tend to blame it on businesses, not on consumers. They go, okay, the consumer's fine. I don't see that happening. But businesses, that's what I'm really worried about. But yeah, that's a topic for another day. That's a topic for another day. Okay. Marisa, anything on the consumer you want to bring up? Anything worrying you that hasn't been mentioned? And that's okay if there's nothing. I'm just asking.
No, I don't think so.
Okay.
I'm feeling pretty good about it. I'll just mention, we get a lot of listener questions, and we've had a lot of questions asking for our excess saving estimate, an update on that. You mentioned Scott Hoyt, who compiles these for us. And so the data were just revised because the BEA did comprehensive revisions, right, to the GDP statistics. And along with that, they revised the savings rate. So our estimate of excess saving as of the middle of this year is about $1.9 trillion. Over half of that, though, is in the very top of the income distribution, the top 10% of the income distribution. And then it's kind of spread out. The bottom 20% has 6%. And then you're looking at anywhere from 6% to about double that for people in the top half of the income distribution, the 60 to 80 and the 80 to 90. So there's still excess saving out there for every income distribution, but it's definitely dwindling at the bottom end of the distribution, right? So back to what we're talking about, and if there's risk out there, these are the people that are most likely to have to put things on credit cards to finance spending. And as this goes on, if we're facing higher oil prices for a long time, if we're facing higher interest rates for a long time, this is certainly where the risk is at the bottom of the income distribution. But for right now, they do have excess saving left.
Did you define excess saving? Do you want to take just a minute to
this
define
is the
it?
latest.
You didn't define it, though. What is it?
I didn't define it. That's right.
I don't think so. Did she?
No, I did not define it.
Okay.
So we've talked about this before. So this is a measure. The Federal Reserve puts one out. There's other measures of it. We take the Fed's data and we do some of our own estimates and combine it with other sources of data. So we looked at what the savings rate was prior to the pandemic. And we compare that to today, and we say, are we still at 7? I think we were at 7%. As the sort of equilibrium savings
6.
rate. Is that right?
Well, because of the revision you mentioned, it's closer to 6.
Okay.
It
So
was
so
7
yeah.
plus.
All right. So with the BEA data, right, the kind of pre-pandemic savings rate was 6%. So we look at any saving above 6% as being quote unquote excess savings. So saving above and beyond sort of what this pre-pandemic equilibrium saving rate was. And so that we are estimating at $1.9 trillion as of the middle of the year. There's a bit of a lag in the data.
So Chris, that feels like a warm blankie to me. No? It should make you feel very comfortable about the consumer. I mean, the
distribution, right?
You're worried
distribution,
middle and high income households.
It's highly dependent. It's highly skewed in that direction.
Yeah.
And then there's a question of how much of that, well, I guess this is a philosophical debate. Is this, how much of that savings is truly available for consumption versus, have the households actually classified that as wealth at this point?
Yeah. Here's my theory on that. If it's sitting in your checking account,
This
it's
is
not wealth. It's not socked away somewhere. That is, I can see it in my bank account. If I need it, I will use it. Right? No?
Well, if I need it, I will use it is a recipe for avoiding a prolonged recession, right? Avoiding the downside risk, right? I have a shortfall, I have the savings, I can fill the gap.
Yeah.
It doesn't lead to additional spending.
No.
So it's not an accelerant.
But it's insulation, nonetheless.
It's insulation. Yeah.
It's a warm blankie I've been talking about. In fact, that might be a good title for this podcast. We got to get the warm blankie in there. Or Blanky. Well, okay, we're running short of time. You mentioned listener questions, and you're saying there were a lot of questions around excess saving. Do you want to throw out one other question? We'll take it before we call it a podcast.
Yeah, can I go back to a question about CPI, because we have several of the same question about
Yeah.
owner's equivalent rent.
Mm-hmm.
So owner's equivalent rent is the implied rent that a homeowner estimates they could get for their house were they to put it on a rental market, right? So Mark mentioned that rents make up a very large portion of the consumer price index, because the cost you pay for your housing is the biggest cost you have. So there's a lot of questions around OER that are skeptical, I would say, in tone, like how good are homeowners really at estimating what they could get for their homes were they to put it on the rental market, or they have some expertise about the rental market that they're accurately estimating that. And why is that even a thing? Why aren't we just measuring rents directly? Why are we asking homeowners what the value of their home would be on the rental market?
Chris, do you want to take a crack at that?
Sure. So I guess I would, going back into my memory here. So as I recall, the survey of the homeowners in terms of what they expect they could get for their rent, for their homes if they were to rent it, that number is used as a weight.
Yeah.
But the actual price, the actual rent in that owner's equivalent rent calculation is actually from the rent survey.
Yeah.
Right. So the listeners are correct in their assessment, and that is actually what the BLS is doing. You could still argue, well, maybe that weight isn't the greatest, right? Because you are relying on us, but the impact, I would argue, on the overall calculation is muted, right? Because you're not actually relying on that homeowner to declare what the rent is and use that as the actual price, right? So,
I think it all goes back to market rent. It's actually it's the rents that folks are actually paying in the marketplace that ultimately drive the owner's equivalent rent and the rent for shelter numbers. So I don't think there's that bias that the listeners are implying in the data. So I don't think that's an issue. Although having just said that, all of a sudden I'm worried that maybe I'm missing something or I forgot something. Probably we'll go back and take a look and just make sure I have that right. Yeah. Okay.
I mean, the series are are very highly correlated. The primary
with
rent
rents.
series.
Yeah.
So
right.
Even if they're not measured precisely, they're still quite informative. Right?
Yeah. Okay. All right. I think we're going to call it quits. It's late afternoon on a Friday, and we've got lots of sports here in Philadelphia. We got Phillies tonight, got Phillies on Saturday. We got Eagles on Sunday. So a lot going on here. Got a lot of games. You don't care about this, do you, Marisa?
I do.
You do? Okay. You're still a Philly fan?
I mean, mildly.
Yeah, mildly. People don't know this.
I've been watching the Phillies.
Yeah, have been. Okay.
Yeah.
Because you lived here for how many years?
I jump in during the playoffs.
How many years did you live in Philly before you moved out to Southern California?
I mean, almost my whole life.
Oh, really? You're a Philadelphia native? Oh, I didn't know that.
Yeah.
Oh, I didn't know that.
Yeah.
Okay.
From Boston to Philly when I was 6 or 7.
Oh, that explains a lot. Now I understand you better.
Yeah.
That whole Boston thing.
Yeah. There's some Boston in there.
There's some Boston in there. Okay. Very good. Chris, David, anything?
Are you conflicted by Phillies victory and the prospect of recession?
I know.
Oh yeah, I thought you were going to bring that up. Actually,
you want to explain that? Does someone want to explain that curse? Yeah, go ahead.
I think you should because
you know baseball better.
Well, every time the Phillies win the World Series, there's economic calamity.
Yeah,
right. 2008, 1929, I think, wasn't it 1929? So there's this theory based on data. We got 2 data points. So, 2 data that whenever the Phillies win the World Series, buckle in, baby. So, I am conflicted because I want the Phillies to win, but certainly don't want a recession. So
the economy was already in a recession when the Phillies won the World Series in 2008. though.
Oh, is that right? That's probably. Oh, you're
Well,
right.
yeah, because they would
Yeah, of
have won
course.
the World
Yeah.
Series in October, and
There you go.
the recession had started a year before.
There you go. I knew she could come up
So
with a
so
reason.
it's good. You can root
It's
for
good.
the
We're
Phillies
good.
with
We're good.
abandon.
Yeah.
Correlation,
Okay.
no causation.
1980 though. Got 1980.
I forgot 1980, right? 2008, 1980, 1929, right? I forgot 1980. So all really pretty abysmal years for the economy. So
It seems like the statistic is that when we are in a recession, the Phillies are more likely to win a World Series.
oh, that's what
Whoa.
it is. That is
I mean,
interesting.
we're already in a recession. Is that what you're?
I'm just saying, in both of those, in 1980 as well, right? We were already, I think a recession had already begun
Right.
by the time the Phillies would have won the World
Probably
Series.
wasn't declared by the time.
Yeah, it wasn't
Oh,
right.
yeah,
None of
yeah.
these things were probably declared by
But
NBER
we were
yet.
in hindsight, we were definitely
Yeah.
in. Yeah. I know it sounds like we should do some research here. What do you think? We'll have one of the young economists take a look.
Well, this
Really,
is a topic I'm sure our listeners are going to jump all over. So
I'm sure.
I'm sure I'll
I'm
get
sure.
some emails about
This
this.
is the
I'm sure.
typical.
Well, please, listener, send in your questions. We love them, and we'll definitely try to get answers to them in future podcasts. But guys, I think we're going to call this a podcast. Everyone have a nice weekend. Take care now. Talk to you next week.